Right now, as we watch the tickers flash across the screen, SMX, Security Matters PLC, is trading at exactly 100.22 USD, having plummeted by 35.60 points, which translates to a staggering drop of 26.21% just during today's intraday session. If you are looking at your screen wondering if your data feed is broken, it is not. This is one of those moments in the market where gravity takes hold with a vengeance, and if you are holding positions, that red arrow feels heavier than just a percentage point. It feels personal. We are witnessing a classic correction, or perhaps something more structural, unraveling in real time. When a stock sheds over a quarter of its value in a single trading session, it is rarely just noise. It is a statement. The market is speaking loudly. And right now, it is screaming, caution. Most investors logged in this morning expecting volatility. This is SMX after all, a name synonymous with wild swings and headline-driven momentum. The expectation was likely a continuation of the recent speculative fervor, or perhaps a mild pullback as day traders took profits. But reality has delivered a harsh blow. This isn't just a pullback. It is a liquidation event for many short-term holders. The divergence between the tech innovation narrative that bulls love to cite and the capital structure reality that bears have been warning about is playing out right in front of us. You might have seen chatter on forums or social media about this being a discount opportunity, but let's pause and look at the mechanics of what is actually happening. When a stock creates a gap down of this magnitude, it creates a psychological ceiling. Every trader who bought in yesterday or earlier this morning is now underwater, creating a layer of resistance that will be incredibly difficult to break through in the short term. To understand why this is happening, we have to look beyond the simple price action and talk about the environment in which SMX operates. This is not a blue-chip stabilizer like Apple stock, or a massive compounding machine like Nvidia stock. This is a company in the trenches of the microcap and small-cap world, where liquidity is lower and volatility is a feature, not a bug. The move we are seeing today, down over 26%, is often the result of a vacuum in buying pressure. When the bids disappear, the price has to seek lower levels to find liquidity. This is the harsh truth of online investing that many new entrants learn the hard way. You might be using the Robinhood app or checking your Fidelity mobile app, seeing the percentage drop and feeling the urge to buy the dip. But in situations like this, the dip can keep dipping. The selling pressure we are seeing today suggests that institutional support, if it was there, has stepped aside to let the dust settle. Let's talk about the volume. Heavy selling volume on a down day is a bearish signal because it indicates conviction. If the stock was drifting down on low volume, we could call it a lack of interest. But a crash on high volume means people are exiting, and they are exiting at market price, not waiting for limit orders to fill. They want out now. This is where the psychology of self-investing becomes critical. If you manage your own portfolio, perhaps through Schwab Intelligent Portfolios or a standard individual brokerage account, you have to separate the technology from the stock. SMX has compelling technology, we'll get to that, but the stock is a financial instrument subject to supply and demand, dilution fears, and market sentiment. Right now, sentiment is fearful. The broader market context matters here too. We are seeing a rotation in risk assets. When high beta names like Tesla stock start to wobble, or when the broader indices hit resistance, the furthest out on the risk curve, stocks like SMX get hit the hardest. It is the whip crack effect. A 1% move in the S&P 500 can translate to a 10 or 20% move in a stock like this. Investors using interactive brokers platforms often use these drops to gauge the overall risk appetite of the market. If interactive brokers' stock trading data shows massive outflows from the microcap sector, SMX is simply getting caught in the riptide. This is why investment help often stresses diversification. You don't want your entire financial future tied to a ticker that can lose a quarter of its value while you're having lunch. Let's shift gears to what SMX actually does, because the disconnect between their business potential and their stock performance is the central tension of this story. Security Matters is not just another software wrapper. They are deep in the physical-digital bridge. Their technology focuses on marking materials, plastics, electronics, gold, fashion, at a molecular level. Imagine a barcode that you can't see, can't remove, and that survives recycling, melting, and manufacturing. That is the promise. In a world obsessed with ESG compliance and the circular economy, this tech should theoretically be a massive winner. They are effectively trying to create an Internet of Materials. The expectation here is that major global supply chains will adopt this tech to prove sustainability. If a car manufacturer wants to prove their plastic is recycled, or a jewelry brand wants to prove their gold is ethically sourced, SMX provides the verifiable data. That is the dream. The reality, however, is that adoption cycles in industrial supply chains are excruciatingly slow. While investors want SoFi stock-style growth, or the viral adoption we see in consumer apps, industrial tech takes years to pilot, validate, and scale. The drop today reflects the market's impatience. The press releases might look good, but the revenue recognition is the hurdle. The market is effectively saying, "Show me the cash flow." This brings us to the elephant in the room: dilution and capital raises. Companies in this stage burn cash. They burn it on R&D, they burn it on sales teams, and they burn it on legal fees. To keep the lights on, they often have to raise capital. This usually happens through equity offerings, which increases the number of shares and dilutes the value of your existing holdings. If you are trading on Fidelity investments or holding shares in your Fidelity IRAs, you need to check the share count history. A stock price adjustment of this magnitude often smells like a reaction to financing news or the anticipation of it. If the market sniffs out a capital raise, they will sell the stock down to the price of the offering. It's a brutal cycle. Furthermore, we have to discuss the platform dynamics. SMX is a favorite among retail traders who frequent investing sites and forums. When a stock becomes a retail darling, it becomes subject to momentum waves. You see a surge of buying on Robinhood stock trading platforms, driving the price up disconnected from fundamentals. But when the momentum breaks, as it has today, the exit door is narrow. Everyone tries to sell at once. The Robinhood cash management accounts that were flush with liquidity yesterday are suddenly hesitant to deploy capital today. This creates an air pocket in the price. The volatility is also exacerbated by high-frequency trading algorithms that detect the weakness and short the stock aggressively, pushing it down further to trigger stop losses. Comparing this to other platforms, users on SoFi Invest or SoFi Active Investing might be seeing alerts popping up about biggest losers of the day. This visibility can actually cause more selling. It's the paradox of online investing. Real-time data can sometimes lead to panic rather than informed decision-making. If you are using Fidelity Wealth Management Services, your advisor would likely tell you that this level of volatility is unsuitable for a core portfolio. It is a speculative bet, and speculative bets require iron stomachs. Now, I want you to pause for a second and engage with this reality. Comment below how many shares of SMX you currently hold and what your average entry price is. Are you averaging down today, or are you cutting your losses? Seeing where other investors stand can give us a fascinating look at the sentiment that isn't captured in the charts. Let's look deeper into the expectation versus reality framework regarding their partnerships. We have seen announcements regarding fashion, sustainability, and gold traceability. The expectation is that these pilots turn into multi-million-dollar recurring revenue contracts. The reality is that a pilot program is often just a test run with little to no guaranteed revenue attached. The market today is discounting those future cash flows heavily. It is looking at the burn rate and asking, will they survive long enough to cash the check? This is a harsh assessment, but in a high-interest rate environment, or even a normalizing one, the cost of capital is high. Unprofitable growth is being punished. If we look at the trading infrastructure, Interactive Brokers platform users often have access to advanced shorting data. High short interest can lead to short squeezes, which is likely what caused previous spikes in SMX. But today's move suggests the shorts are winning, or they are reloading. When a stock drops 26%, shorts are in the green, and they have no incentive to cover unless buying pressure returns. This lack of covering keeps the pressure downward. For those using Fidelity ETFs or Fidelity mutual funds, you won't find SMX in the conservative baskets. This is an outlier asset.